Good afternoon, everyone, and thank you for joining us on today's webinar, MLPs, Come for the Yield, Stay for the Growth. My name is Will Hershey of Yorkville Capital Management, and joining me on today's call from Yorkville will be Portfolio Manager Jim Hugg and Founder CIO Darren Scheringa. If you have any questions during the course of the prepared presentation, please feel free to type them into the text box in the bottom right corner of your screen. We'll hold a Q&A session at the end of the call, and we'll do our best to answer everyone's questions. As a reminder, participation in today's call is eligible for 1 CE credit, so be sure to enter your CFP number if you've not yet done so. With that, I will turn the call over to Darren.
Thank you, Will, and thank you all for joining us on our quarterly conference call. We'll start out here by looking at MLPs during the Great Recession of 2008, the performance of MLPs during the Great Recession of 2008 versus the Great Energy Recession of 2015. And I know we've shown you this chart in the past, but it's eerily how similar the downward path of MLPs were, and you're looking at the performance at the peak to trough as measured by number of days and then back out. On the way down in 2015 versus 2008, we had really MLPs moving down in lockstep. Now on the way back up, what you saw in 2008 is MLPs within really a year had recovered their losses and were back to high water marks, their high water mark of the previous high. And currently MLPs are still significantly below their peaks. And that is actually, in our opinion, is an opportunity. Looking at MLPs as an asset class is still a relatively attractive entry point. We'll talk more on that through the call. So 2016, it was a good year for MLPs overall. It was an excellent year for Yorkville last year. This next graph is looking at the beginning of the year starting at 100. You can recall a year ago, February 11th, that was the low of MLPs for the year. That was also the low of oil put in on the same day. And then MLPs started their climb back up from, almost a 30% loss in the first 6 weeks of the year, which was really catastrophic. It was frightening how MLPs has underperformed. Through the course of the year, really throughout from February straight on to the end of the year, MLPs had positive performance. A lot of the performance came in the beginning of the year, and then really saw flatlining of performance from May through October. You see the line flattens out, and then after the OPEC deal was announced at the end of in October, you started to see MLPs again with oil prices firming and the outlook for a rebalancing of the global markets positive based on OPEC's cuts, or at least happening earlier than they would have fundamentally, that MLPs started to get a bit upward into the end of the year. So to quantify that, MLPs, if you look at the final bar in this bar chart, MLPs is measured by the Yorkville MLP Universe Index, which contains the entire population of MLPs, so all publicly traded master limited partnerships are part of this benchmark. We believe it's the most accurate way of tracking the asset class. MLPs, again, were up 21% on the year, and we look at that was the best performing their equity income asset class relative to REITs, utilities, or high yield, which high yield had an amazing year as well, being up 17.5%. A lot of that is energy driven in the high yield space. So as energy credit quality improved over the course of 2016, we saw high yield getting a really good bid and having an excellent year. Utilities, again, up 16%, solid year. S&P 500, 12%, REITs up 9%, and the U.S. Treasuries were slightly positive on the year. What led to the MLP growth in 2016, if we sort of look at the asset class on a fundamental basis, you had 2016, from the beginning of the year to the end of the year, was really an opportunity for management teams to strengthen their balance sheets. saw a lot of capital market activities coming in, which was designed to pay down debt. A lot of preferred issuance coming in 2016 as well, to add to the capital structure, to lower leverage, to really get their financial houses solidified and in good order. A lot of distributions were not increased in 2016 for a similar reason, increased coverage ratios, doing everything in management's power to shore up their balance sheets, their financial position, their cash flows, to make their earnings and distribution growth going forward even more stable. And again, the ability to weather further downturns. So MLPs spent 2016, the majority of it, shoring up their balance sheets. We now believe as we enter into 17 that we're getting out of this transition stage, the cyclical bottom, and we're moving into a new growth phase for the asset class. On a yield comparison, if you look at this next chart, the MLPs as an asset class are yielding 6.6%. That compares favorably to every other alternative income-producing asset class, whether it's high yield, and you have heard us say this many times, the difference between MLPs and high-yielding fixed income securities is just that, they're fixed income. In buying a bond, the income will never grow. In buying an MLP, you're buying an operating company, which by the very virtue of its structure has the ability, in theory, to grow in perpetuity its distribution. So there's growth of distributions that come out of MLPs versus fixed income. So for growth in income, you're actually getting paid more in income over high yield, and you're getting the extra benefit of having income growth between MLPs and high yield. And then if you look at the other alternative equity income producing asset class of REITs and utilities, MLP spread above REITs, you're picking up 2.3% more income from MLPs and 3% more income over utilities. Both of these numbers are at the higher end of their historical trading ranges relative to REITs and utilities, as REITs and utilities are trading more towards the higher end of their valuation ranges as measured by yield and a number of other metrics. So moving forward, why would investors want to continue to hold MLPs, and if they are not in the asset class, why would they want to think about getting into it or getting back into it? Because we know a lot of investors are sitting on the sidelines right now, wondering whether this recovery is sustainable. They've been burned by MLPs before and are a little gun-shy before getting back into the market. So why now? I think there's 4 primary reasons the way we view the market currently: attractive valuations, improving oil prices, increasing U.S. production, and the support of administration are the reasons why MLPs make a lot of sense right now. The first one, attractive valuations, is, as an investor, to us, that's the most important aspect. You pay the right price for an asset, it's half sold, and the entry point is so important on the total return that you're going to earn over the life or your investment horizon, whether it's an individual security or looking at an asset class. So attractive valuations, when we look at MLPs, and that these 4 charts are looking at MLPs, utilities, REITs, and the S&P 500, we keep using these 4 asset classes so there's continuity across the presentation. Look at the charts. Utilities are trading, and this goes back to 2000, utilities are trading at their all-time highs. REITs are trading at their all-time highs. The S&P 500 is trading at its all-time high. MLPs are not trading at their all-time highs. So looking, and a reason for that is REITs, S&P 500, and utilities all experienced the Great Recession of 2008. You can see that in their charts where there's a dramatic fall-off as MLPs did. Utilities, REITs, and the S&P 500 did not experience the great energy recession of 2015. They're not energy companies, so in 2015 they did relatively well versus MLPs, which experienced another 50% pullback over the course of 2015. So we think this is from a valuation standpoint, an entry point into the asset class just based on these charts relative to 52-week highs, really attractive right now to be in MLPs. So the price is good. It's an attractive entry point. Number two, you're looking at improving oil prices. If you, again, we went back to the highs of 14 for oil, the summer of 14. Oil was at $105 a barrel, 76% decline in oil. Similar to what we experienced in 2008, another it was a 77% decline back in 2008. Oil bottomed in February at 26. It's trading in the mid-50s right now, so it's up over 100% from its bottom. Why do oil prices matter? Ultimately, oil prices matter because the higher the oil price, the more profitable E&P companies are. The more they're going to spend in capital expenditures to increase their drilling programs, which ultimately increase the flow or the production from their various wells. The more production that comes out, since MLPs are primarily energy highways, the more flow that goes through pipelines or the energy highways, or as Len likes to put it, to the veins and arteries of the U.S., that MLPs are the primary beneficiaries of this. So oil prices are off the lows, again, put in roughly a year ago. They're up into the mid-50s. Our forecast, our thoughts on oil prices, we really don't forecast oil prices, but our thoughts on oil prices is that for the foreseeable future, oil prices will trade at the U.S. marginal cost of production. The U.S. is the low-cost producer of oil. We have the ability to increase our production significantly due to our unconventional shale plays. We are one of the few countries in the world that have the ability to ramp as quickly as we can due to the vast resource that we have in the United States. The fact that we've also started to export oil, which was only put into effect last year after a 40-year ban. The U.S. finds itself in a really enviable position from an energy superpower position right now. So oil prices, the U.S. marginal cost of production before, so back in 2014, your fringe plays in North Dakota were $60 a barrel. And at $60 a barrel, we would have all been happy to invest in these plays because they were profitable. At $26 a barrel, there were very few basins that were still profitable at that level, although there were some. Right now, oil in the $55, what we've seen is two things happening in the U.S. as part of really this energy revolution that we're experiencing, led by unconventional shale plays, is that the cost of production is coming down on a per barrel basis because efficiencies are going up. So to put that in plain English, we're able to recover more resource from the ground in shale plays than we were before. The more resource we can recover from the ground with the same amount of CapEx going into it, it lowers the cost per barrel. So there's this wonderful efficiency coming into place. The U.S. now, those same fringe plays in the Bakken are probably running at 55, maybe even lower than that. We see the trend is the cost per barrel continuing to come down across all basins in the United States. So your $40 basins are now $35, your $20 basins are now into the teen levels, and this cost trend will continue. We've equated it to Moore's Law and computing power, but into the energy sector. So the U.S. will be the marginal producer of cheap oil on a global basis, and our costs, as I just mentioned here, are sort of in that, at the most 60. So $40 to $60 is really a band that we see oil trading at for the foreseeable future. If it trades there, production in the U.S. will continue to move higher. So, 2, improving oil prices. 3, we're seeing in rig counts, before production goes up, you need to bring rigs on. You need to do more drilling. So if you look at the peak from, again, oil prices dropped in August of 2014. Rig counts took a few more months before they turned over. lagging from oil prices. They lag on the way back up, they lag on the way down, they lag on the way back up. As you can see here, rig counts went from 2,000 and they dropped at under 500. So you saw really 3/4 again, similar to the price of oil, 1,500 rigs come off, and we're no longer actively drilling. What we've seen from the trough of May of last year and June of last year, so early summer of last year, rig counts have grown by 350, a long way from their peaks. There are other arguments we don't need the same number of rigs because efficiencies have increased so much per rig, which also leads us to the downward cost slope and the price per barrel. I won't go into that on this conversation. It's sufficient to say rig counts are moving back up. When you have rig counts around the 500 or above level, you'd expect production to increase in the United States. So number 3, increasing U.S. production, and you'll see that here. As rig counts come back up, U.S. production, it peaked at 9.6 million barrels per day back in the summer of 15. From peak to trough, which would have been the fall of last year, we saw 1.2 million barrels of production come offline in the United States. That is an incredible sum on a global basis. And what we've seen from the lows in the late fall of last year to current, we've seen over 500,000 barrels come back on. So oil prices went up, rigs started to come back on, and now you're seeing production follow. Ultimately, that's setting us up for good growth in volumes, flowing through the pipelines, starting with the gathering systems, throwing through the pipelines, and ultimately redounding to the benefit of MLPs. So again, it's in the 4th point now is a supportive administration. President Trump spoke last night. He again spoke on infrastructure spending, so clearly I had ovations from both sides of the House. So spending on infrastructure generally, specifically behind U.S. energy independence. We've seen his support of this industry with 2 executive orders for the Dakota Access Pipeline, DAPL, and Keystone XL. And it was interesting. I was at a conference in Utah meeting with one of the CEOs, and they said there's a possibility that we've heard, maybe even on his first day in office, President Trump will do something regarding DAPL. And he said, I think the President's probably got better things to do on his first day in office. But it wouldn't be surprising if before early February something happened, and it actually happened within his first week, that he signed an executive order for DAPL. So this administration is keenly aware of the economic benefit and the job-creating power of the U.S. energy industry. So that is the final tailwind, as we see it, behind MLPs. In summary, again, attractive valuation is that MLPs, unlike other U.S. asset classes, are not trading at historical highs and not trading at peak valuations. We have improving oil prices, which we believe will remain in this range for the foreseeable future. We see increasing U.S. production, which has been verified of late. We're up over 500,000 barrels from the lows, and we have a supportive administration that's in office for the next 4 years. So it not only does it look to be a good entry point from a valuation perspective, but also from a fundamental perspective, there's a lot of macro tailwinds behind the asset class currently. The topic of our most recent MLP beat was come for the yield, stay for the growth. And although that is cute and a nice play on words, and I have to thank Will for that, it is also something that Yorkville has recognized from the asset class going back to Jim and Len's investing in MLPs, which dates back to the early 90s when they started to look at them. So virtually the inception of MLPs. They recognized MLPs, the yield's wonderful, but what differentiates MLPs from other high-yielding instruments is the growth of distributions. And so Yorkville has always viewed MLPs based on Jim and Len's early work as it's a total return asset class. We don't look at them, MLPs, for income solely. A lot of people are attracted to MLPs for the yield, which is wonderful. We'll take current income. We'll take current income as long as it gives us growth of income as well. And why is that? In the MLP beat, and you can get that on our website at yorkvillecapital.com. We discuss in a little more detail. The majority of returns of MLPs, as this bar chart shows, come out of price appreciation. And to quantify that, we're looking at growth MLPs here, which is our specialty. 71% of the returns from 2009 through 2016 came from price appreciation, only 29% from distributions. I remember when we first did this study, I was shocked to see that MLPs actually produced more of their total return from price appreciation than income, given how high their income was. On the next page here, we actually compared MLPs. So let me explain the chart a little bit. The higher the bar, the better. That means from 2009 through 2016, the best performing asset class was MLPs relative to REITs or to utilities. And the best performing of MLPs were distribution growth leaders. So growth MLPs. Makes sense if the majority of your returns coming from price appreciation is driven by growth of cash flow, growth of distributions. The second part of the analysis looks at MLPs. The black bar, that's the percentage of the total returns. Again, higher, better, higher total returns. The percentage of the total returns, whatever they may have been over this period of time, broken down by price appreciation or capital gains versus current income. And so growth MLPs were significantly above the MLP universe, which produced 60% or 58% from price appreciation, and the balance 40% from current income, versus MLP distribution growth leaders, which produced over 70% from price appreciation, so driven by growth in distributions, and only 30% from current income. And if you look at the difference, a significant outperformance, because the higher the bar, again, the higher the performance over MLPs in general. So growth historically has led to better performance. If you look at that relative to utilities or REITs, it's MLP distribution growth leaders or growth MLPs relative to utilities. Utilities produce 62% of their returns from price appreciation, and actually REITs produced approximately 70% over this period of time from 2009 through 2016. So it is much higher than most people would expect from income-producing equities, the percentage of returns that come from capital gains versus from current income. And it holds true across not only MLPs but other asset classes as well. When you look at growth MLPs here, so the black bar is looking at growth MLPs, and we use our index called the Yorkville MLP Distribution Growth Leaders Index, and that is a rules-based index that takes the 20 fastest growing MLPs and rebalances it every quarter in an equal weight fashion. So it's a very pure growth index, and compares that to the Alarian index in this bar chart that you're looking at here. What is interesting is if you look at every period, 2009, the first period of recovery, through 2015, so up markets, recovering markets, and then into a down market, growth MLPs outperformed on both the upside and the downside. Highly unusual to have a asset class produce alpha both on the upside and on the downside. Generally, if it outperforms on the upside, you'd expect it to underperform on the downside. And we don't see that with growth MLPs. So better upside performance and actually better downside performance. The 2016 is the one anomaly where actually growth MLPs underperformed the Alarian index. we look at this on the next page, and that period of underperformance here leads us to believe and that growth MLPs are poised to outperform going forward again. Why? Fundamentally, the thesis that growth drives your price appreciation, so growth of cash flow, growth of distributions. And for another reason, we believe MLPs, growth MLPs are poised to outperform when looking at 2016 as an anomaly. 2016 was the first year that we were coming out of a cyclical bottom for energy stocks, and MLPs fell into that as well. So there, generally speaking, there's a junk rally phase of investing. And when you come out of cyclical bottoms, the companies that were mispriced and started to get priced for bankruptcy that aren't going to go bankrupt, or started to get priced in for distribution cuts that weren't going to cut their distributions, generally high yielding, attract investors due to their high yield and mispriced valuations are where investors go first. You want to get paid to wait. And as long as you're confident that your income isn't going to be cut, and you know that as the valuations adjust to more normal ranges, that you have a tremendous amount of upside. Just forget about growth, just on valuations changing. So we saw that as being the phenomena of 2016, the junk rally stage of the cycle. And looking to 2009 through 15, a 7-year period there, that growth MLP significantly outperformed. We believe we're moving into the expansion stage now of longer-term recovery. I don't know whether it's 1, 2, 3, 4, 5, however many years it may be, where now it's a market that will reward growth of distributions again over high current income, and it becomes more of a stock picker's market as well, which is wonderful in the markets that we excel in as an investment team. So moving away from the macro, I just have a couple of points because I know we've had a lot of questions from investors recently, so we're going to open it up a little earlier today for questions. A couple of slides on the Yorkville MLP core income strategy. The strategy you'll see after this call and on our website at the end of the month will start to be, is being rebranded. It will be called the Yorkville MLP Growth Opportunity Strategy. It's more reflective of the portfolio and the way we invest as a firm. We're also introducing a couple of other strategies, a high income strategy at the same time, and an equity U.S. energy infrastructure strategy, which is invest in C Corps versus MLPs. So as part of that introduction of new strategies and a rebranding, this will become, a flagship strategy will become the Yorkville MLP Growth Opportunity Strategy. I'm going to use that name right now. So the core income strategy, going to be the Growth Opportunity Strategy, which finished its 16th year. It's one of the oldest strategies in existence in the MLP space. Had a wonderful year. If you look at the Alarian Index and look at the 3 bars on your right, the Alarian Index was up 18% on the year. On the black bar are our gross returns for the strategy, up 29%. So Yorkville delivered 10% positive alpha over Alarian in 2016. That is a similar experience that investors had with us going back into through 2015 for the previous 5 years. In the last expansion stage, we outperformed the Alarian as a firm by 10% per annum, so delivering or generating 1,000 basis points or 10% of positive alpha over Alarian for a 5-year period. And we actually won an award as the best performing MLP manager over that 5-year period based on the performance. If we're right and we're moving into another expansion cycle, MLPs are positioning themselves for that type of growth rate again over an extended period of time from a good base, a good entry point, a good valuation. You're not buying them at their peaks right now, you're buying MLPs that still have a significant way to get back to highs, and then growth in distributions due to new projects that are coming online and new production volumes out of this country will take MLP growth rates higher than where they are today. So a wonderful year for our strategy. We're off to a really strong start again in 2017. We'll talk about that in a little over a month here. And so our second slide on this, it just breaks our performance down into a table. I'll just focus on the graph at the bottom. The core income strategy, annualized 5-year returns, 10.1%, 2.2% for the Alarian Index, again, generating 8% positive alpha over a 5-year period of time. And again, as we all know, past performance is not indicative of future performance, but I'd certainly rather bet on someone who's done something before than someone who's never done it before, with a higher probability of doing it again. So on that note, I am going to turn it back to Will. I want to thank you all for your patience, listening to my prepared remarks, joining us for this conference call, and Will, back to you.
Great. Thank you, Darren, for the presentation. With that, we'll now begin the Q&A segment of the call. As a reminder, if you have any questions you'd like to have answered, please type them into the text box in the bottom right corner of your screen. And it looks like we already have a few, so why don't we start off here. The question is as follows. Given that growth and price appreciation is such a large component of MLPs, the interested party wants to know, are MLPs okay to own an IRA? It makes sense, given that that's where they're coming from. So, Jim, now we're not going to provide tax advice because we don't do that, but if you can just...
This gets a little tricky in owning MLPs and IRAs, and I would suggest that you consult your tax accountant on this. But for those that they can be, if they do well in a regular taxable account, they're going to do equally as well in an IRA. The performance of, as Darren talked about, I've been involved with this asset class going back to the 90s, and it's been a very rewarding, experience. And I think if you invest in the asset class over a long period of time, as one of the slides pointed out, you're going to get rewarded with current income, but the big bang that you're going to get for your buck is in capital appreciation. So I just think that they're certainly suitable for taxable accounts because in taxable accounts, if anyone on the call is, I'm sure most of you are familiar with the way that the distributions are treated. About 80% is tax deferred for a taxable account, and this is a very, very powerful investment asset that you have when you're not paying tax and the tax is deferred over a long period of time.
Thanks, Jim. That actually just plays into one more question, somewhat related, regarding the distributions being tax deferred. What happens, and this is a little bit kind of a higher level MLP question, but what happens when you sell your MLP investment relative to the distributions that you've found?
Well, as I mentioned just a minute ago, on average, about 80% of the distributions that you receive when you own an MLP, and it varies, of course, but is tax deferred. So over time, this deferred tax builds up. Now, if you never sell your MLP, you're never going to have to pay that deferred tax. If you do sell your MLP, assuming that you have a capital gains tax, that's the way it works for owning any stock, any C Corp. You will pay the difference between where you bought the MLP and the price at which you sell it, and you will pay a capital gains tax. The second thing that happens, however, is that there's something called recapture, and they will go back, the IRS, or it will show up on your K-1, and then you have to pay a tax on all that deferred income that you've received over the years, and you will pay tax at your marginal rate. There is one other thing to consider, and this is good for estate planning, that if you have a number of MLPs in your portfolio and something happens to you, namely you get run over or something, your estate inherits the MLPs. They get a step up in cost basis just the way they do with a regular C Corp, but all of that deferred tax liability disappears. So it makes your heirs very happy that they won't be hit for this, and you don't have to worry about it because you're not around anymore.
A little dark, but great. Thank you, Jim.
Yeah.
Darren, I'll let you take a stab at this one. Given what we've seen with One Oak and WMB in terms of kind of moving away from the MLP structure, do you see the MLP structure lasting long term? Does it have a place?
Yes. I think it does have a place, because the MLP business model is ultimately a cost of capital model. So the cheapest source of capital, both debt and equity, will win in the MLP space. In fact, so that as long as the tax advantages of MLPs, higher current income, produces a premium valuation, a lower cost of equity and debt, or equity specifically, let's leave debt out of it, lower cost of equity, the MLPs have a comparative advantage in bidding for projects, and they can pay more for a project and have it be accretive to their bottom line or distributable cash flow relative to other competitors who are bidding on those same assets. So that is, and then that would be, I'd say, if MLPs ever stop trading at a premium, and which would mean your yield would get very high too, so it's always enticing investors back in who are looking for current income, then it wouldn't work, because now you'd be at a comparative disadvantage, so there'd be no advantage to the structure. And it's interesting, when MLPs at the beginning of 16 were trading again into the teen levels and some into the high teen levels, that model's not going to work. There's not many projects you're going to be able to build that are going to generate free cash flow that will produce a return in 20, 30% for cash on cash in an investment. So it becomes very difficult to make acquisitions work, or even to make projects work, when that becomes your hurdle rate. Your hurdle rate gets too high. So in summary, MLPs as a structure do work. Because the MLPs, again, because it's a cost of capital game. MLP structure lowers the cost of capital. There's valuations generally, you start to look at income valuations, which generally inflate some of your other valuation metrics, enterprise value to EBITDA, which is a good one. As long as you have a stronger currency, you can go out and do accretive acquisitions. The second point, and I'll wrap it up on this, another trend that's going on right now has been the roll-up or simplification, a word that you hear tossed around in the space a lot, and I think that trend will continue for the same reason. So what does that mean? That means that the LP-GP structure, the limited partner underneath the general partner, then the general partner ultimately received something called incentive distribution rights, which were designed to align the interest of the general partner, which had operating control over the limited partner, to grow distributions of the limited partner on a per share basis, so accretively. And in doing that, they would take a larger percentage of future cash flows when they reach different levels. So everyone, it aligned interest. It made a lot of sense. What we've seen now with the LPs buying out the GPs, so getting rid of that incentive distribution right, the incentive distribution right at the top levels becomes 50% of future cash flows. That becomes a cost of capital disadvantage. So now the MLPs that don't have GPs and the IDR split anymore actually have a competitive advantage or comparative advantage relative to MLPs with GPs. So I think that trend continues. I think there won't be a lot of GPs around with IDRs in the future, and because of the cost of capital disadvantage that they have. But MLPs in general, I think what you'll see the investment bankers do is it makes sense to become a C Corp now, and when you have a tax shield, and when you no longer have the tax shield, you know what? It makes a lot of sense to become an MLP again, and they make commissions on both sides of that. And we've seen that in the corporate world. You know, you need to get bigger by consolidating and becoming a conglomerate, and then a conglomerate that's not efficient, you need to break your company apart into its pieces again. So some of this is just a game of.
I was going to ask what the over/under on the Kinder Morgan MLP was, if it was 2020 or earlier, but
I'm going to answer.
Sure.
Just to follow up on Darren's point about the cost of capital, over the years you've had a number of E&P exploration production companies that have formed MLPs, and the reason why they've done this, and then they will form the MLP and they will put some midstream assets into the MLP, and the purpose of that is to avoid corporate income taxes. So it's a great way because the MLP, as Darren elaborated on, has a lower cost of capital because it's not paying corporate taxes. It's a pass-through entity. So you've had many of them. Most recently, you had Noble do it. That had a very successful offering of an MLP. Phillips a while ago, and I think Hess is going to be coming out with an MLP. I think sometime in the first quarter. And the reason why they're doing it is simple. They've got midstream assets that they will put into an MLP and do an IPO on it, and everybody is happy.
Great. Thank you.
You know, just a follow-up to Jim's comments, there also are certain midstream infrastructure assets, stable cash flow, long-term contracts. It makes a lot of sense in an MLP as a pass-through vehicle. Commodity-based, cyclical companies, not as much sense. And I think we've seen this in the most recent downturn, that virtually, not all, but almost all E&P companies that were structured, so exploration and production companies in an MLP structure, have gone bankrupt. That's telling of the weaknesses of certain businesses going into an MLP model. And historically, if you look back to 1986, 80% of MLPs, so 1986 is when MLPs came into being. That was the year under Ronald Reagan, the Tax Reform Act of 1986 that formed MLPs, that 80% of MLPs at that point were exploration and production companies. Fast forward to today, even more now, but 80% of MLPs now are midstream companies and 20% are commodity-based companies. So the whole market has realized that the midstream assets make sense in this pass-through structure. Cyclical assets, not as much.
Exactly. Great point. This participant's wondering, they've used C Corp MLP funds in the past and invested in true MLP. What is your structure and what are the tax ramifications of your structure? I think I can handle that, but feel free to jump in. In terms of the MLP core income strategy, which, as Darren mentioned, will be the growth opportunity strategy, we currently offer that in separately managed accounts where you get the benefit of direct investment and the pass-through benefits that Jim talked about. You do, however, deal with the K1s. We also have it structured in a mutual fund wrapper as well. That would be more the C Corp type MLP investment. So we do offer it both ways, whatever works for you and or your clients. We do have available. Next question here, Darren, for you. You mentioned that oil is likely to trade range bound here. If that's the case, then how can MLPs grow if oil is going to be, call it 40 to 60?
Because volumes are going to increase. Because break-evens on basins where E&P companies can generate a reasonable return on their investment, investors can generate a reasonable return on their investment, will be below that rate. Anytime oil prices are above my break-even rate, my economic return, there'll be more production. And MLPs benefit from production. So that's the reason. Let me go one step further. It's in 2000 through 2002, so the tech bubble bursting, MLPs were up so it was down 4 years, 3 of the 4 years. MLPs were only down 1 year, and they're only down slightly. So MLPs really offered differentiation and protection against the markets in those early years. And then when you looked at MLPs, the correlation over a market cycle, so from 2000 through 2016 would be a good example, relative to oil, excuse me, the correlation is very low. It's definitely under 5. It's around 3 and 0.3 something. So that would be a great diversifying benefit relative to oil if you wanted to add MLPs but didn't want direct exposure to the commodity price. Now, why is that? Why is there a low correlation? Well, not because of the down markets, because we know in 08 and again in 16, MLPs in oil, the chart, I didn't put an oil chart, I could have overlaid oil in, oil dropped 77%, right, and MLPs followed it down. So our belief now in managing investors' expectations, although your income in our portfolio, we had no MLPs cut in 08, again in 2015, so fundamentally we're able to pick MLPs that are going to weather the storm and their income will be secure, meaning your income as an investor will be secure. So if you can close your eyes to price volatility, which at 50% gets pretty difficult, and just clip the coupon, we do think MLPs now on the downside will be tied to oil prices, and for a number of different reasons, but not fundamental, generally speaking. The second part, when you look at if oil gets capped at the $40 to $60 range, when companies can generate economic returns on oil because their production levels are cheaper, that's what we experienced in MLPs in the last cycle, too, from 2009 through 16. Oil prices didn't continue to go up all the time. They flatlined, which is okay. Oil prices should flatline because they're not operating companies. It's a commodity, and it's driven by supply and demand. The operating companies, MLPs, continue to increase production rates, continue to increase their pipelines, continue to increase throughput, continue to increase their gathering assets, storage assets, all their energy infrastructure assets, which continued as any other operating company by building and making acquisitions to grow cash flow. So oil prices stabilize. These are not E&P companies which need, a different business model, volume times price. These are throughputs. So oil prices stabilize, but the growth of MLPs, the infrastructure MLPs continue to go up because new projects were needed, new assets were needed. And that's ultimately the growth story we're talking about here. The power of MLPs is that they're operating companies that aren't tied, that are tangentially tied to commodity prices because you need to produce more oil in order to have more flow coming through MLPs, but they're not directly tied to them like an E&P company would be.
Good point.
And even if the price of oil remained flat, it still made sense to complete DAPL. Bakken needs to get the oil and gas out of there, and DAPL had been in the works and it had almost been completed until it was stopped by several months ago by the Army Corps of Engineers because of a directive from the White House. But so it just proves the point, as Darren pointed out, that even though you might have flat oil and gas prices, projects are still going to be needed. I mean, recently they found an enormous new deposit in the Permian, and you're going to have infrastructure to take that oil and gas out of there. So there's always stuff going around, and that needs to be addressed, and you need assets to pull the oil and gas out, and you need processing plants and so on to to process it and fractionate it and so on.
And there are not only the big pipelines that we've mentioned, DAPL Mariner East was recently approved, which has been in the works for a number of years, and there may be an expansion on top of Mariner East as well. It's an open bid right now to see if they can get the anchor tenants to support the development of that pipeline, and that's here on the East Coast. And the Permian, given its expansion in production, already with brownfield expansions, which means doing little expansions on existing infrastructure to increase volumes, there's the forecast is by early next year there will already be tight capacity constraints, offtake, so that will need another greenfield pipeline coming out of the Permian already. So these projects aren't ending. I think the other one we'll probably see under the current administration is TransCanada's pipeline coming back into Keystone. So there's no end to the amount of infrastructure, and this is something we haven't even touched on here, but the potential of the U.S. to produce energy from our current levels, we have 100 years of natural gas reserves at current levels. We have 50 years of oil, and it's not inconceivable that our ability to produce here, we're already one of the largest, and were at one point the largest oil and natural gas producing nation, larger than Saudi Arabia and Russia, that we'll get back into that position and it'll be sustainable. Again, it's not inconceivable we'll be producing something significantly higher than where we are today, and that could be measured in oil in the mid-teen levels of production to upper teens. That's doubling our current production almost. So it's incredible where the U.S. finds itself right now in the global energy space. We're the world's, there truly has been a revolution in this country, and we are the largest oil-producing nation now globally when you look at natural gas and oil together, and growing.
I think you guys both touched on it. Production is the name of the game for the midstream MLPs. The molecules, as some in the space like to say, need to get from the wellhead to wherever it is they need to get to, and that's how we're going to benefit as investing in the midstream space. I think we're coming up close to the hour here. Let's start with one more and see if we have time for another. Jim, this touches on what you had just talked about. Hearing that estate tax reduction or elimination would include eliminating the step-up provision, would that be a big problem for long-term holders? Any thoughts on that?
I'm not too sure I understand the question.
Sure. The question is, one of the participants is hearing that there's potential for eliminating the step-up provision in terms of estate planning.
Okay.
Would that be a big problem for long-term holders?
Well, that would apply to anything, not just MLPs, but if I understand what the person is asking. So, I mean, whether you own IBM or Google and at very low prices, or any MLP at a low price, if they do away with that step up. I mean, I read something a while ago about it. Not just because I hope it doesn't happen, but I think it's unlikely, particularly with the current administration, that they're going to eliminate the step up, and when someone dies.
Okay, great. It looks like at this time, feel free to get in your last questions here, but if there aren't any more, we'll wrap up. So just want to thank everyone for your time on today's call. As a reminder, as always, we will have a replay of the webinar available on our website, www.yorkvillecapital.com. And want to thank you all again, and hope to talk to you soon. I think Darren has one more.
I do, and I just, because we just posted it this week, we have our K1 tracker up again. So it's a single source to get all of your K1 information off the internet. We publish it and update it on a daily basis. So as soon as the company produces its K1 online, you can use that resource, click onto it, and it'll take you directly to to the K1 page that you're looking for. So it's another way that we try to work with our investors or potential investors to simplify their life and help them navigate the MLP asset class.
Great. So just thank you all again, and hope to speak to you in a few months. Take care.